All
Okay, so
right.
welcome
So once,
everyone. Oh,
go ahead.
sorry, Mike. Didn't mean to cut you off. Welcome everyone to today's Be Well Lunch and Learn. We are so excited to have Mike here from Empower. He is one of our Penn State Health retirement plan advisors. He has joined us here in the past, so we're so excited to have him back today to talk about the sandwich generation and juggling the financial needs of your kids, yourself, and your parents. Just a few reminders, these sessions are recorded, so if you are unable to stay with us for the entire length of the hour, feel free to check back in. We will send a follow-up email within the next day or two with the link to the recording and the PowerPoint slide. And then, of course, if you have any questions for Mike, he does a phenomenal job at answering as many as he can with the time he has. So please feel free to pop those in the Q&A feature or the chat box feature. We'll try to monitor that as closely as we can. I know Mike will also talk about ways to follow up with him after today's session if you would need more support or resources. So with that, Mike, I will pass this over to you. Thank you so much for being here today.
All right. Yeah. Welcome, everybody. My name is Mike Fillier. I'm one of the retirement plan advisors for Penn State Health. And today we're going to talk about a term you might have heard in the news, might not, and that's really the sandwich generation. And we're going to kind of define that. We're going to go into some other information. But first, if you don't know, Empower is your retirement plan provider at Penn State Health. And hopefully you have logged in and signed up for looking at your accounts online so that you're well familiar with your retirement plans. But Empower is the second largest plan provider when it comes to retirement plans in the US. Number one is Fidelity, Empower, and then everyone else is a very, very distant third. So we've got a lot that we can do for you because of our size. Really, anything to get you to a better retirement outcome, that's what we are all about. Helping you reach your financial goals both now, short term, and we're actually going to talk about that more today, and long term goals. Please reach out to us and we will help you. That ongoing support and guidance doesn't end if you leave Penn State. I work with retirees and former employees all the time if those funds have been left in the Penn State plan. And best of all, we are free, paid for by Penn State. So take full advantage of everything that Scott and I can do for you. There are two of us assigned to Penn State, and we are fully dedicated to all of you at Penn State. So with that in mind, sandwich generation, what is it? Well, it's a more common than you might think in that it's an adult who is responsible for care and support of both their dependent children and elderly family members. This term really started coming about in the news about 12 years or so ago, and there's been lots of research done on this. And unfortunately, more and more of us are falling into this sandwich generation, whether it's the obligation to take care of an aging parent, uh, or children who may have launched but have returned home, or that we are somehow still supporting, even though they are no longer a dependent per se. We still may have care that we're giving, whether it's financial or otherwise, to our children. So, are you part of this? If you're close to retirement and have any kind of children that you are responsible for, again, whether that's living with you or financially supporting, and of course, any kind of elder care that you are giving to anyone. So, what does that really mean? Well, unfortunately, about the research is showing that about 35% of us or 40% of us are in the sandwich generation. I myself am or was part of this. Had to take over care for my father about 4.5 years ago, right in the middle of COVID, and had to move him because he had a fall from Oregon all the way to here in Pennsylvania, and then took care of him until he passed away just a few weeks ago. And at the same time, had two adult children, one who was just about to launch and one who was in the middle of college through all of this. So 80% of those who are taking care of both their kids and an elderly adult feel overwhelmed. That data is from March of 2022. 45% of our children are still receiving financial help from their parents, even after they move out, or maybe they moved out and moved back in, which seems to be a trend that is happening quite often. And then, of course, 84% say that when they are in this sandwich generation, it is negatively impacting their ability to save money, specifically for retirement. And that's, of course, what we are all about, is trying to make sure you don't blow up your retirement savings because you're in the sandwich generation. So, things to really consider and questions to ask. What are those needs that you might have with your parents? And you may not quite be in the sandwich generation yet, but maybe you see it coming, depending on the age of your parents, or if there's health um, uh, uh, situations that are ongoing that you know. For my dad, and as an example, with Parkinson's and then the onset of dementia because of his Parkinson's, he was suddenly doing great. He was on his own, riding motorcycles, and then suddenly had a fall, and everything changed overnight. And so we never know when these events are going to occur, but the best thing to do is really kind of look at those now and begin preparing and planning to ease that strain when the situation occurs. And of course, our children, what are their needs? Have you set boundaries? Have you discussed with them when they have to move out, or what it looks like if they're staying at your house, to try to, again, ease both the financial and possibly the stress that's going to come with all of that caregiving? And then, of course, don't forget about yourself. I've been in this business now for about 23 years, and I started out on the banking side, and had my licenses, and really tried to help people save money there as well, as a banker. But one of the things that I always ran into was um, something happened in the family, and suddenly someone is a caretaker, and that caretaker is trying to do everything on their own. Well, I don't know if you are in that situation or know someone who's been in that situation. Even if you're only giving care to your spouse, or possibly you have a child who has special needs, you know that if you're trying to do everything on your own for that person, you are going to wear yourself out, both emotionally and physically. So, having that understanding that you've got to still care for yourself through all this is critically important. So, let's talk first about those loved ones, potentially parents, but it could also be another relative that you might be caring for. People are living longer. So, some interesting statistics that I always love to share. For a married couple that reaches age 65, there is a 50% chance that one of them is going to make it to age 92. Now, you might think that's great, or that might terrify you. But either way, statistics are telling us that we are living really long. And if you're married when you hit 65, one of you is probably going to see your 90s. So we need to prepare for that and make sure that we're not running out of our financial resources before that age. Only a third, sorry, I advanced too quickly there. Only a third of those folks that are currently at age 65 are going to need long term, or I'm sorry, going to avoid long term care. So that means two-thirds of us are going at some point to need long term care help, whether that's in home care or in some sort of medical facility or long term care type of place. In the case of my father, my wife and I tried, but unfortunately could not meet some of his needs because of the Parkinson's. He had significant mobility issues. The dementia was kicking in fairly hard when we moved him back here to Pennsylvania. And so we had to look for a care facility for him. And of course, you know that those are not cheap. So One of the things that we are big about is prepare for that future, right? Regardless of whether you think your parents need it or even want to consider it, have that conversation before something happens, before that health event, or they are forced to somehow have further care that they need and may not be able to provide for themselves. This is by far the hardest thing. My dad never wanted to talk about his finances and never wanted to talk about needing long term care. So he had put in place nothing. Thankfully, we did have at least a power of attorney. So I was able to at least manage things that way. But he just didn't want to even think about any of these preparations. So I can tell you from personal experience, have those conversations, try to figure out what assistance they're going to need and when, who is going to do it, be familiar with their Medicare. Where do they have their insurance? What does it look like? Are there other family members, siblings, brothers, or sisters that can assist with that family member? Figuring out all of this or having those conversations before the situation is forced upon you is really, really important. And of course, I know none of us really want to have these conversations, but I can assure you, and the statistics bear this out, it is in your best interest to try to figure things out and have some sort of plan in place before it's suddenly dropped in your lap. So, what do those care considerations look like? Well, rising healthcare costs are going up. In the case of my father, he had very good pensions and a very nice Social Security benefit, but we were still deficit spending to the tune of about $5,500 on a monthly basis to have him in this care facility. So, without some sort of financial plan, that money would not have lasted until he passed just a few months ago. Figuring out longevity is a critical important factor, and of course, funeral expenses. Now, thankfully, having been in the financial business for a couple of decades now, my father already knew what he wanted when his end came, so we had already made those preparations. But many adults don't want to ever think about that. They don't do any preparation. And so that's left to you to figure out. So, again, have that conversation. Thankfully, in my dad's case, he wanted the simplest cremation and wanted it taken care of as cheaply as possible. But even so, I can tell you it still cost more than $5,000. And that's here in Pennsylvania. If you retire somewhere else, who knows what that cost might be. And then finally, depending on the family dynamic, there could be disagreements over how care is handled, who's going to pay for what, and who's going to have that access to those finances of that family member that you might be giving care for. So again, it's critically important to have that plan. Where's the financial support come from? Thankfully for my dad, Social Security. He had two pensions, one from the state of Montana that was very generous, and then he had some small investments. And so with all of those, now my dad was renting. He didn't have a house, so there was no equity. My dad was unable to work. He did have very good Medicare coverage. So all of that, unfortunately, I have to tell you, I didn't know anything about until I took over his finances and it was all dropped in my lap. And even though I have a sibling, she was in a position in her life where she was unable to give me any assistance whatsoever. So, having all those conversations during my dad's intensive care stay in Oregon, trying to figure out how to move him several thousand miles so that he could get the care he needed here in Pennsylvania, all of that was incredibly stressful. Now, your parents might be nearby, who knows? But if they're not, these conversations still need to be had. And you should, even though they may not want to think or talk about it, you really do need to talk about their finances and how things are going to be paid for. So, with all of that in mind, figure out who's going to do what beforehand. Figure out who might be able to help when it comes to those finances, and who's going to be taking on those different responsibilities. being able to have another family member assist with even doctor visits, or allowing you to go on vacation, or distributing all of the care and financial matters to more than one person might be very beneficial and lower that stress when it comes to caring for that parent or that elderly family member. So, first and foremost, you got to have those conversations, keep everybody informed, and make sure that you are taking care of yourself. And above all else, don't blow up your own retirement plan or your finances trying to care for that elder family member. So now we're going to switch to kids. Hopefully, a better topic, a little easier, probably, if you have children in the household, or maybe they have successfully launched, or maybe suddenly they've come back into the household. But if you didn't know, having a child in the house typically adds about $6,500 a year just in food cost. And that's not including the additional electric, water bills, and other things that you're going to have to be doing, like extra loads of laundry, more gas in the car, all of those other things that come with having that child in the house. Again, that statistic that I find crazy: 45% of people ages 18 to 29 are still getting financial help from their parents. So figure that out, right? And of course, daycare costs can be insane. Right now, the general average of daycare throughout the United States is almost $1,200 a month. Here in Pennsylvania, it's more than that. It's closer to $1,600 or $1,800, depending on the age of your child. And, again, even if you're staying at home or working a part-time job and trying to stay, at home, the cost of having that child adds dramatically to our monthly budget. And then, of course, there's college expenses. More than two-thirds of us, 66% of parents, consider paying for their children's college tuition as a parental responsibility. Now, I can tell you, in my household, that responsibility was on my kids. Based on our household, I told them early and often that if they wanted to go to college, the dime was theirs. I would help sign or co-sign for loans if they couldn't get enough through the federal government. But they had an understanding of how all that worked long before they made the decision to go to college. It is critically important that you set limits and define what you're going to pay for and for how long. I had a banking customer whose son knew that the parents were going to continue to pay, and so he stretched his college years into about 7 and still didn't have a degree. So make sure that you set limits, understand what those limits are, and share those with your children as you grow up. If you're going to save for them and use something like a 529 plan, understand and tell them this is the limit. This is how much you get. You've got to make it work, and then the rest is going to be on you. Figure out what you are willing and able to give to them. And again, even if they're going to stay at home, with my kids, they knew that as soon as they graduated, they could stay at home and pay off those student loans. But if they had a job and they were making enough to pay off the student loans, they were also going to help pay for their food and upkeep at the house. My son chose, he had a great career, chose to move out almost immediately upon getting his degree. My daughter stayed a little longer and chose to try to pay off some of those student loans before she got married and moved out. So again, setting those expectations is critical for your financial success, as well as lowering that stress level for you and the household. Now, with kids, you can use a flexible spending account where you set aside pre-tax dollars throughout the year to be paid and used for medical expenses, as well as childcare expenses. But you have to use those FSA funds before the end of the year. Sometimes you can get the bills submitted in January, but you basically have to use it within the calendar year. Tax credits, obviously, having children, our tax code is very friendly to those that have dependent children in the house. Think of using those child tax credits, if that means you get money back, and setting that tax refund aside to help pay for their ongoing costs or as college funding. And then, of course, um, figuring out how you're best going to use those tax credits, whether it's for those 529 plans or that FSA tax credit that you get as well. But make a plan, have it, and stick to it so that it is not derailing your future retirement or your current budget. Other things to consider, of course, in-home daycare could be cheaper. Teach your kids about money early. Figure that plan out for college, as I mentioned, and set those boundaries for adult children. Know that if they're staying in your household, they need to pick up some of the slack or they need to get out. Set those boundaries early and often and have those discussions, no matter how painful they might be for you or the child. They have to figure out that there is some responsibility they have when it comes to getting older and still sponging off mom and dad. Now, I can tell you that I have now successfully launched both of my children out of the house, and they are both on their own. My daughter is working hard to pay off just a couple of her remaining loans, and she went into healthcare and has her RN certificate. So she is doing really, really well. My son went into cybersecurity, so he's got a great job and will probably soon be making more money than me, which is what you want for your kids. But again, they have both moved out, paid off their student loans, and are now successfully moving forward in life. So I would wish that for each of you. And the best advice I can give you is have a plan, teach them about money. If you don't know anything about money, come to Scott or I. We help with budgeting, and online I'll show you that there's a budgeting tool and other things that you can use to really take control of your finances, get a plan, figure out how to save for those short emergencies that you might have, as well as for retirement. So with that, now we're going to talk about some of those tools that you have access to and meeting your own needs when it comes to being part of the sandwich generation. First and foremost, if you don't have a budget, make one. I'm going to send, we have a worksheet that is typically part of this. I'm going to send that out so that that can be set along with the slides for anybody who wants it. But have an emergency fund. Figure out your mortgage or your rent. That's a big part of everyone's expenses nowadays. Figure out what you're setting aside for college and caregiving. And then, of course, those things that you have to have, food, keeping the lights on, insurance on the car, versus the things that might be nice to have, such as vacations or the big screen TV or things of that nature. So all of that should be part of that budget. And figuring out how you're going to allocate those precious funds is very critical and always the first step. From there, figure out healthcare costs. And again, what's your retirement going to look like? The average retiree is spending about $400 a month on healthcare, especially as they age and hit their late 60s, early 70s. For most retirees, 20 odd years in retirement means they're paying just for their own healthcare roughly $96,000. Now, there's several studies that have been done by Medicare and the federal government. You can go look them up, even at ssa.gov. And most retirees end up spending about $190,000 throughout their retirement lifetime on healthcare. So that's got to be part of your retirement plan and your retirement spending. Making that money last throughout retirement is critically important. And if you don't have a budget now, you're really going to need a budget when you get to retirement. So having one now will help you plan for retirement. Knowing what you need now means you can project accurately what you're going to need when you retire. And again, Scott and I can help you with that. So set up that appointment with us. So what's your level of preparedness? Now, normally, if we were using a different platform, we would poll the audience here. But just think of what your answer might be. You're very confident you're going to have enough to be able to retire and live for 25 to 35 years in retirement. You're somewhat confident, you're not confident, or you have no idea what you're doing when it comes to retirement. Any of these answers are okay, but just know that only 18% of the folks that are typically pulled in this type of poll say they're confident they're going to have enough income for their entire lifetime. So it's critically important that we get everyone to a better understanding of what that retirement need is, what your budget is, both now and for retirement, and how we can help you meet those goals. So, with that in mind, let's talk about some of the tools and other things when it comes to budgeting. First and foremost, short term goals. Anything less than 5 years, you're going to have in cash or a CD or a money market at the bank. Right now, high yield savings accounts are very good because we have higher interest rates. You can get about 4.7% in a high yield savings account on that cash and keep it liquid. So whether that's a car in the next couple of years, whether that's the vacation, which you might be taking yearly or whatever that might look like, whether that's a home remodeling plan that you have, any short-term goal, you're going to want to save that cash and put it aside. This also includes your emergency savings. Setting aside a little bit each month for those expenses we know are going to occur is critical to making sure you get rid of or stay out of credit card debt when it comes to those emergencies. Two things I always like to throw out on this particular slide. Number one, we know the tires and brakes on our cars are not going to last forever. So set aside $30 a month, and in 2 years, right, you're going to have enough to replace those tires or do that brake job. So set aside and have a car maintenance fund as part of your basic savings and make that part of your budget. We know those things are going to go bad. Same thing when it comes to home repair. We know the roof's not going to last forever. We know our appliances, our refrigerator and stove are not going to last forever. Same with the washer and the dryer. Set aside a little bit of money so that when those do go bad every 8 to 12 years, you've got the money to pay those for those, and you don't have to go into debt. Long-term savings goals, this might be purchasing of a home or even a second home or a boat, some larger purchase you might be doing, or saving for a college for your children, especially if you have young children and you've got, a decade or more to save the money. And then, of course, saving for retirement. Any goal that is more than 5 years out, and like for most of us, retirement might be 15, 20, 35 years out, depending on your age. This is where instead of saving the money at the bank or in a high yield savings account, we are investing that money. We're now using some sort of investment that's going to give us better than the normal interest rates to let us grow that money. And that helps us in two ways. Number one, we're going to hopefully compound the interest on that investment and grow it much faster than having it in cash in the bank. And then number two, we don't have to save as much if we're getting a good return on that investment. So those are the two big ways that by investing the money for that long-term goal, you don't have to save as much because time is your best friend in making that money grow as you add a little bit each time you contribute to it. So just a quick note on Medicare. As much as we want it to cover everything, it doesn't. It is an 80-20 insurance plan. They only cover 80% of most things. 20% is going to come out of your pocket, which means you've got to buy up that gap coverage or have a supplemental plan. Medicare Part A and B is what we pay for. A is free. And then the Medicare gap, or typically for prescriptions, we're going to have to buy up that coverage. And that's why the average retiree right now is spending about $400 a month on those premiums. So again, $96,000 just to pay for that gap coverage in retirement. So make sure you have an awareness of that and make sure you're saving enough to keep that in focus. So what does this look like and what can we do to help you? We can help you figure out that budget and what that looks like. We can look at different forms of insurance and how that might assist you. Distribution options of your plan throughout retirement, we can help with that as well. Investments, understanding what they are, making sure you're comfortable with the risk. You should always be looking into that. And then, of course, getting rid of debt, always a good thing. One of the things I always throw out there is if you have a house, typical 30-year mortgage right now is around $345,000 on average in the United States. On a 30-year mortgage, if you do one extra principal payment a year, That shaves 8 years off that 30-year mortgage, and on a roughly $345,000 mortgage, will save you about $67,000 of interest you don't have to pay the bank. So if you want to find out more or figure out how you can do that, make that appointment with Scott or I. And then, of course, are you going to relocate when you retire? What's the cost of living going to be where you're going? Not all states are equal. Pennsylvania is very friendly to retirees. They don't tax any of your retirement income whatsoever here in PA. So it's a great place to be. So is Florida. However, healthcare costs in Florida are significantly higher than they are here in Pennsylvania. So just be aware of things like that if you're planning on relocating. And taxation, and especially sales tax, is not the same in every state. Neither is the cost of your health care. Some states are much more expensive than here in Pennsylvania. And then, of course, make sure you always have an up-to-date beneficiary on your plan. Use our retirement planner to really dig into what you're going to need for retirement. And the last one, come and see us. We are the retirement professionals that can help you get to a better outcome. So, online, we've got a free budget planning tool for you. One way you can always start a budget is to collect your receipts on a weekly basis and then see where your money is going. There's lots of easy tools. I like going to a website called NerdWallet. It's nerdwallet.com. They've got wonderful investment knowledge builders, as well as budgeting tools and spreadsheets that are all completely free for you. We also have a lot of these on our website at retire.pennstatehealth.org, and I'll share that with you here in another couple of slides. And of course, we have that budget handout. I'm going to email that to Angela to get out here so that we can make sure you can get that if you want it. So if you have a lot of debt, how do you get out of the debt? Well, the first thing you got to do is figure out where it is. So write down who you owe, what the balance is, what the interest rate is, and what the minimum payment and due date is. And then use the snowball method, which means you pick one of those bills that has either the highest interest or the lowest balance and pay everything extra that you can afford on that one particular debt. And then when that one's paid off, you move to the next one with the lowest balance or highest interest rate. This will snowball you out of that debt, and it really does work. You can talk to Scott or I, and we can help you figure this out. And again, there's things online that are free for you to look at. So, key points to remember before we show you the website and some of the things online that you have. Caring for those aging parents and children at the same time is going to be more stressful, both physically, mentally, and financially. So don't let it blow up your life. Figure out ways to lower that stress. Don't allow elder care to derail your financial goals, both now and for retirement. And of course, the hardest thing of all of this is you've got to have those open conversations before an event occurs and suddenly you are the caregiver, which is what happened to me. I don't recommend it to anyone. It took me more than a year and a half to figure out my dad's finances. Unfortunately, it was a total disaster. He still had stock certificates, and you may not even know what that is, but they are paper certificates of ownership in companies that belong to my deceased mom that I had to go through an enormous process in getting fixed, the titling on those fixed so that we could access that money. He didn't think they were worth anything. So unraveling that and getting all of that taken care of took more than a year of time, and I had to hire an attorney because some of them were joint with an ex-wife. So all of this needs to be done before it's dropped in your lap. So having those difficult conversations, I cannot tell you how helpful that will be for you. And have those difficult financial conversations with your children as well. Set the limits on finances for them early. Share with them how to budget. They will thank you later in life, even though they may not appreciate it at the time. So remember, you're not alone. We are here to help you. And where do you get that help? Well, it's at retire.pennstatehealth.org. You've got a personal empowered dashboard. You can load into our budgeting account your current checking, credit cards, other accounts that you have all in one place. It's very easy for you to do. We've got a learning center link there that has videos, online courses, and assessments. They're all super short. We have found that if we make them too long, people tune out. So most of them are 3 minutes or less, either reading or watching. And then, of course, we've got lots of financial planning calculators for you. So there it is, PennStateHealth.empowermytime.com, or use your phone and scan that QR code, and that'll take you right to our scheduling tool to set up that appointment, that one-on-one consultation with either myself or Scott. We are here for you, paid for by Penn State, so take full advantage of this free service that you get access to. And what do you want you to do? Again, there's that website, retire.pennstatehealth.org. You can call our customer service line if you have problems accessing things online. But we can help with any of those financial related questions. We're going to review and understand what your current financial situation is if you want us to, and try to get you to a better outcome for your financial future. With that, we just have a couple more slides here and some disclosures that I do have to put up on the screen. But remember, we're free and we'll do everything we can to assist you. We do have a number at Penn State that is 717-531-1878. And we've also got a Penn State Health email that's psh_retirement@pennstatehealth.psu.edu. So feel free to use those. That information or that phone will go directly to us and we'll be able to respond to you. Or just go to the website and we'll be able to, if you go to retire.pennstatehealth.org, the first big block there says schedule a meeting right now. Just click on that and schedule that meeting with us. So with that said, that really is the presentation. I'm just going to quickly show you these disclosures. This first one here is really that Scott and I can act as a fiduciary. We do have a managed investment platform that you can enroll in if you'd like, and we can guide you through that process. We are really here for retirement education and do everything from basic budgeting all the way out to retirement planning. And then, of course, Penn State is adding an HSA, so we can be able to assist with that and guiding you through all of the nuts and bolts of that. And then, of course, the investment disclosures as well. All investments carry risks, have fees and expenses. You can come to us to find out more about what's in your plan and how it all works. So with that, what I think I'm going to do is back up to this slide right here, which has all the pertinent information, especially the website. And then what I think I'm going to do is try to see what we can do to address any questions that we might have. All right, let's see if I can see those questions. Doesn't look like there are any questions. So are there, does anyone have any questions for me that I can answer, or anything I can add or that they want to add to the presentation?
Mike, I just want to pop in and say thank you so much. Great presentation as always. Great information for our folks to have. And while people still may be typing their questions, I just want to put a quick plug in for our next Lunch and Learn on October 1st, which is Healthy Relationships, Building Supportive Connections. So that's about 2 weeks away. So just a quick plug for that. I do see a question. Will the slide deck be shared? I will send a follow-up email with the slide deck, the recording link. I'll send that extra resource, Mike, that you were saying about. I think it was a budget sheet.
Yep.
Expect that within the next day or so. But I do see a question for you, Mike. For parents, do you recommend getting long-term care insurance?
So that's a very individual question. And the best answer I can give is the earlier you get it, the cheaper it will be. So it's important to explore that as soon as possible rather than wait to get it later. Currently, there are very few long-term care policies that I would recommend, And Scott and I do have our insurance license, so we're very familiar with long-term care policies. And one of the problems with the policies nowadays is that they are so expensive that if you pay the premium for around 10 to 12 years, you're going to have paid for the benefit that you're going to get. And right now, they're capping most of those benefits at about $250,000. And you can figure out the math of what your premium would be. And so oftentimes it's better to utilize those funds in an investment vehicle, and then just stipulate or segregate that money so that it's for long-term care. Because unfortunately, many long-term care policies are just not a good deal anymore. But it is very individual. It depends on health, and it depends on resources that you have in your family. So someone did say thoughts about permanent versus term life insurance. So the easiest way to answer that is term life insurance is you're buying it for a term. And it's also what you have with Penn State Health, right? Everybody gets covered at least to their salary. As long as you work, you've got that. That's term. Or you might have a 20-year term policy and you're paying a fixed premium every single month. Term life. It is the cheapest form of life insurance. Permanent life insurance builds some sort of investment or cash value over time. It is going to be far more expensive for the amount of coverage that you receive than term. So again, it's a very individual question on whether or not you can afford that permanent life insurance that's building some sort of long-term value that you'll be able to get at some point, versus term, which is just like car insurance. The only time you're using it is when you need it. Scott or I can have a sort of a greater kind of discussion on that on a one-on-one to see what might be best for you. It really does depend. Someone else asked, can we offer guidance for people paying their children's college out of pocket? Again, that's really a budgeting, right? That's a budgeting question. How much can you afford to do, as they're in college? How much are you going to have to lend? Is it going to be federal? Is it going to be federal loans or private loans? How do those work? We can guide you through that. We can certainly try to help. Let's see. So scheduling an appointment online, you can either use the QR code, or when you go to retire.pennstatehealth.org, there's a box that says schedule a meeting. Just click on that box and it'll walk you through that, how to do that. Should be very easy to do. Someone asked also about some permanent or whole life policies also have a rider for long-term care in lieu of a death benefit. All life insurance policies can be sort of cashed in for long-term care benefits, but there's going to be a reduction in the benefit paid. So the federal government a few years ago set it up so that if someone is going into long-term care and their life expectancy is shortened because of that long-term care, they can look to their life insurance policy to sort of trade in some of the value to pay for that long-term care benefit. But it is almost never as good as having long-term care insurance. But again, long-term care insurance isn't as good as it used to be. So it's a very, very individual thing nowadays. Really, it comes down to your ability to pay for it versus can you make more on just investing what those premiums would be. And so it really depends on your individual circumstance. So someone has asked the question we get all the time: is there a way to figure out how much money I'm going to need in retirement? Yes, absolutely. We have a calculator as soon as you log in at retire.pennstatehealth.org to your account. That's going to kind of show you income replacement. There's two easy ways to figure out how much you're going to need. The first way is depending on your budget, right? So let's say your household budget is $5,000 a month. Well, guess what? $5,000 a month times 12 is $60,000 a year, right? And if you're going to live long, you're going to need $60,000 a year for roughly 25 to 30 years in retirement. So that's about $1.2 million. Now, you might be able to live on less than that. Okay, no problem. You don't need quite as much money. But that's the easiest way to kind of do that calculation. Oftentimes, we will also try to figure out things such as inflation, and our retirement planner online will do all of that for you. It's going to figure out what are we going to make on the investments? What if the economy is bad? What if inflation is high? Scott and I can help you walk through those as well. I think that is all of the questions that I'm seeing. So again, thank you everyone for attending. I really do appreciate it.
Yes, thank you, everyone. Thank you, Mike. I'm sure we'll see you back again sometime in the future. But again, I will be following up with an email with all the resources and additional information. So have a great day, everyone.
Take care.